It can be very tempting in the stock market to become either too cautious, get totally afraid of putting any money in the market, but it's also really tempting to get too aggressive. All of a sudden you have half of your portfolio in some long call options, kind of gambling ahead of earnings season. So the whole point of today's video is to go through a bunch of data about the stock market, where we're heading, what's the sentiment, as well as some potential negative catalysts that could begin a 10 to 15% correction in the S&P 500. Let's begin by looking at the price chart of the S&P 500 because it really just gives us a lay of the land and it tells us about how the average company is going, and things are going really good. You should have seen huge gains in your portfolios over the last 3.5 months, where the S&P 500 is up 24%, but many high growth companies, maybe smaller companies, tech companies, many names are up between 70 and about 120%. However, just because the stock market has done so well in recent memory doesn't mean we're going to see a sell-off automatically. We could even go up another 10% higher across the board for the S&P 500. That means many of your favorite companies are up 20, 30%. That could still be coming in the next 3 months, especially as we get to the end of an economic cycle. People feel like they need to get any ounce of profit, squeeze it out of their portfolio before the end comes, recession, a year and a half of no gains in their favorite companies. One of my favorite surveys I like to look at in terms of investor sentiment tells us about maybe stocks have a bit higher room to move higher, or maybe we should expect a top in the market, and that would be the AAII investor survey. So we just get a simple question: do you think the stock market will be up or down in the next 6 months? And we're sitting at a very awkward place, and we have been for about 3 months, but we've been sitting at a 40-40 split. 40% of people bullish and 40% of people bearish. The only thing about this survey is it has not worked very well, especially in the last 3 months. We've had a huge amount of negativity in the sentiment during a time when stocks keep marching higher, but I guess that also makes sense. If there's a huge amount of people in the negative camp, it just means you have more and more people to come across and continue buying up companies. So if we use that logic, which has worked in the last 3 months, that tells us we've got some room to move up higher. You usually see a topping out in the investor sentiment when bullishness is around 50% or higher. We are not at those levels just yet. And this survey also asks a really useful question. Every week is unique, and I like this week's question a lot. It asks, how have you changed your investing approach recently? We have about half of people saying they are doing no change or little change to their investing. Okay, that's kind of boring. 40% of people are more conservative or much more conservative. Now that's really interesting, especially as stocks have done so well. So maybe this little pit stop in the stock market is just people positioning defensively, kind of like I've been doing in the last few weeks. But that also means people have much more room to grow in terms of getting aggressive. So that means more tech companies, high growth companies, those higher risk names could see some benefit here as people get out of defensive companies and get back into growth. And very similar to that sentiment survey, I have another type of sentiment index, but this time it measures the difference between institutional or smart money and dumb money, like you and me, retail investors. Smart money as of June have become much more neutral. They are no longer plowing in new money into the market, buying up stocks higher. They're now sitting at a neutral level, meaning they're probably trimming positions, doing rotation, but not out and out selling just yet. However, when we look at the dumb money index, we are having an absolute party here. Retail investors are nearly 100% invested. They've gone full in, which is usually a red flag. We are about to see a top in the stock market. The only time we would see stocks go up higher would be for whatever reason, smart institutional money believing there's going to be a really strong period in the stock market in the next couple years. So are we going to see that? I don't really think anyone knows. So I'm probably sitting more in the camp of a sell-off of 5 to 10%, reset expectations, retail investors getting a little bit less excited, and then we could get back to that bullish gain, that bullish cycle, because recession just isn't really here yet. That means stocks are positioned for a 5 to 10% move higher in the next couple months. either up or down. We don't really know which direction, nobody really knows, but we could be building up for some high volatility. The market's kind of gone to sleep in the last month. Earnings could be a catalyst to move in one direction or the other, or maybe there's some other pieces of news that could send us in a certain direction. First up is a red alarm bell that's just started going off in the last few quarters, and it hasn't been set off since really Q1 of 2007 through to 2008, right before the GFC crisis began. This alarm bell, or this graph, is looking at the dollar amount of debt assets held by broker dealers. Debt assets are a fancy way of saying bonds, and in this case, we could pretty much guarantee that we are talking about US Treasury bonds held by these really big banks and also brokers like Charles Schwab. The part that's really interesting, maybe a bit scary as well, is just how fast this increase in debt assets has spiked up higher. We have seen these guys add in about $500 billion in just the last few quarters, which would be effectively doubling their position in US Treasuries. So we've got to talk through why these big banks, these big institutions, could be buying up US Treasuries. Very, very simple investing thesis is when you're going into recession, interest rates usually collapse because inflation's also collapsing. And when you have treasury bond interest rates going down, their prices go up. It's just how they're engineered. So these big banks are pretty much pricing in recession, or at least getting really safe and defensive about their positioning. So do they know something that we don't? Are they getting institutional data direct from businesses? Something about the tariff war? Who knows? The first catalyst was about a signal to help measure of an upcoming collapse. The second catalyst is more of a story telling us about a slow decline in the quality of many companies, especially those that are laden with debt. We are talking about the recycling, the reissuance of corporate debt in America. This graph tells us how much corporate debt is getting recycled, reissued every single month. Corporates don't really pay off their debt. All they do is when they're due to pay people their money back, they just take on new debt, pay off the old people, and just restart the process. Effectively, what we're seeing here is about $200 billion of corporate debt every single month is just getting reissued at the brand new current interest rate, and that's the equivalent of around 10% of all corporate debt getting recycled at a yearly rate. The reason why this is so important is because of the refinance cycle. The lowest interest rates ever recorded or close to it in human history were taken out during COVID. Now, for the last couple of years, corporates at a 10% yearly clip have had to now refinance back at kind of long-term averages, corporate debt sitting at around 5-6%. So every single time we see companies refinance, just think of the interest on their debt roughly tripling. That's going to slowly grind down the profitability of debt-laden companies. And those types of names include industrials, materials companies, utilities, maybe old school telecom or just large dinosaur companies have become laden with debt over the last couple decades, really when interest rates were cheap. However, now it's time to come and pay the piper. And doing some really crude research because I couldn't find anything on Google, I just went on TradingView and saw out of the 8,244 public investments you can make, many of those are just subset companies of others. But overall, we have 1,118 companies have negative equity. That means roughly 1 in 8 public companies across the board have more debt than they do assets. That is a really dangerous place for companies to be in. Personally, for example, I don't really invest in companies with negative equity because that just means a third of your profit, a quarter of your profit is just going to pay interest on debt. And when we tie in this reissuance story, we're just getting 10% worse every single year. And again, this catalyst is a slow moving one, but it goes to show us that we maybe only have another year or two before we start to see many zombie companies start to collapse. Now, getting to the final catalyst here really quick because it's so simple, we just have the forward P ratio of the S&P 500 sitting at a 22. And honestly, people don't really care about valuations as long as company earnings growth is very healthy, which is meant to be this year and next year. But if we fail to achieve that earnings growth of around 13% per year moving forward, as soon as there's a sniff of a fear that won't happen, think the trade war in April, then you're going to see a sell-off in the market. Because we're roughly 20% overvalued in the stock market, that just means, okay, normally let's just say the baseline sell-off is 5%. If we're 20% overvalued, next thing you have a 25% sell-off in the market. With all of the negative news out of the way, let's get some positivity in here, because earnings season, what it's told us so far is that there's still a bunch of positivity out there. Whether it's semiconductor stocks or the big banks, we're getting some clear signs that the economy is still doing just fine, even with all of this tariff war concerns. The first company worth looking at is Taiwan Semiconductor. Now, they're pretty much the single company in the world that can make high-end semiconductor chips, computer chips. They go in things like your AI data centers, supercomputers, or any really intensive industrial computing process. The good news about TSM's earnings from last week is they just reported revenue up 44% compared to last year and 17.8% increase just from last quarter, meaning we are seeing an acceleration of the tech business across the world because all of these big tech names have to go through Taiwan Semiconductors. But I do want to also share some news from the big banks in America, because there's one metric I like to check every single quarter. It's about the health of the economy, and that would be looking at credit losses or credit costs, depending on the company you look at. They call it something different. I've taken a snapshot of the credit costs, credit losses of the three major banks that reported last week. And having a look at JP Morgan up the top, I like their table the best because they actually break it down into two different quantities. First up, we have net charge-offs. They're just the losses the bank took because people just didn't pay back their loans. They took a credit card, took a home loan, and just defaulted, never paid it back. JP Morgan has had flat net charge-offs, which means people are not getting worse at JP Morgan in terms of paying back debt. And also one very positive thing here is the reserve build, which means saving up cash for future losses, actually dropped by over half, which is JP Morgan directly telling us they expect the economy to actually be better moving forward than what they were expecting last year. And this story is pretty much copied and pasted for Bank of America. Things are going pretty good, flat. The only place that was a little bit negative was Citigroup, who actually had a higher credit cost or credit losses, a gain of 16% year over year, 5% quarter over quarter. So you could argue they're accelerating in that regard. The good news here is that Citigroup's business, their revenue growth, the amount of loans they conducted grew by about that much as well. So overall, I'll give this a A- grade in terms of the banks and also Taiwan Semiconductors, telling us the economy is doing just fine. So wrapping up the video here, I just want to look at the upcoming weekly calendar for earnings season. And really it's the following week that's got all the big news, but there is one key name I'm personally going to be paying attention to. It's not Tesla, it's certainly not like an IBM or something, it's Alphabet stock. Google really is going to tell us about people's aggressiveness, their greed in buying up adverts, because that tells us about the confidence about business across the board. Small, medium, big players, everyone buys up Google ads in this modern day landscape. So if Google's business comes in really strong, especially in terms of revenue growth, then that is going to tell us, yeah, the economy is still doing just fine. And maybe I'm a bit biased there. Google's my number one holding, but even still, I think it's a great company for a really good valuation. So I'll be listening on that earnings call. Comment down below if you want me to do a live chat here, like a live stream of the Google's earnings, go through it all together. Anyways, that's the video for today, guys. Make sure you subscribe if you do like the content, hit the like button. I'll see you guys next time. Bye.